It's live on Facebook. So are you going to introduce Jane or shall I?
I just put myself on mute for a moment. Sorry, it's just normally when I start going live, it starts playing on my computer and then I'm talking and it's playing on my computer. So apologies for that. Hello, everybody. Thank you so much. Firstly, sorry that Maxine didn't bother showing up last week. Really disappointing.
I was in training.
She was in training because obviously this week we've got Kate with us again. And we're all really excited, and for anyone that watched last time, we've got an update because I think we were just saying that last time was just before we suddenly realised we were out of lockdown. So so much has happened. So really, really excited to see what is in store for us all in the property market now and going forward. So thank you, Kate, for coming on in.
Welcome.
Okay, so Kate, again, thank you very much. And we are super, super lucky to have you because not only have you shown up on Maxine Leicester Landlord Live, but you've been on these secondary things called You and Yours, Your Money or Your Life, Money Box. So you're really getting out there, little media whiz you. But thank you so much for joining us. And it was in May, we were talking very much about what we thought was going to go on in the market. I was talking about people, we felt that people were paying, majority of people were able to afford rent and things like that. And then all of a sudden, 9 o'clock, 12th of May, we found out the market was going to open the next day. So we were talking about what was going on or what we thought might happen. And I think for what you've got now is really the latest figures on the economy and the market since. So I'm going to hand it very much over to you.
Excellent. Well, thank you very much for having me back. Always a pleasure, as you know. Oh, and host Jane has disabled participant screen sharing. Could you undisable me? Apologise if the phone was going just then as well. I haven't got much control over that. Clearly the BBC are after me yet again.
Oh my God.
What can I do? What you don't all know is that I'm just praying that my Dalmatian, who I've tried very hard to tire out today, is going to stay exactly where he is.
Come on in. You're all right now. You should be able
I'm all right now.
Okay.
Yes. Right. Let me
love this technical stuff.
Babbling about my Dalmatian. But I have got a spare treat in my pocket just in case. So things go horribly wrong. I'll put that on. Here we go. So we're going to talk about the post-lockdown recovery. So we definitely have a post-lockdown recovery, but what we also know is that it just has to stop at some point, doesn't it? So that's really what we're going to chat about. So last time, because I always like to look at the previous presentations, Maxine and I have been doing these for quite a few years, actually, haven't we, Maxine?
I know, it's quite scary.
It is, but we've done all right, actually. We have forecasts and things we've expected to happen. We've got
You're the one that's providing the figures.
So we've blagged our way through it so far and to try and continue to do so despite the uncertainty we have. So last time, economically, we were talking about a V-shaped recovery. So up until Christmas and next year was going to be a bit difficult, but following year, everything was going to be kind of fine and dandy, back to normal. From a property perspective, we have no idea what was going to happen because the market wasn't open and we had no idea that it was about to open up. There was something like 373,000 property sales in the pipeline that couldn't go ahead and had been delayed because of lockdown. Would buyers and sellers be hesitant? Would prices and rents fall? Well, I have to say, nobody predicted that we were going to open up on the Wednesday. I found out through a few media conversations, and it kind of slipped through on the Tuesday, apparently. We definitely didn't expect what happened next. And what I put together here, just to kind of warn you, there are a lot of house price indices, and we normally rely on the land registry, that have stopped producing their data. Rightmove, Halifax and Nationwide have continued, and although I only trust this data to a point, and I only trust it if it matches what people like Maxine are telling me on the ground, because there's a lot of dodgy stats around at the moment, because basically we locked down during that period. To be fair, although I don't rely very much on the Rightmove averages that you see there on the left hand side, so basically this is what Rightmove was telling us after lockdown are the average house prices across the country, and you'll see how much higher than they are and different they are to mortgage sales, and that's because they're based on asking prices, and there's normally, would you believe, something like 40% difference between asking prices and what people are actually paying. So don't rely on those. But what is quite useful is that annual change that Rightmove put in, because it gives you a bit of an idea of what sellers and agents think are going to happen to house prices. So if they think they're going to go up, they will put their property on for higher than it was a few months ago or last year. If they think they're going to go down, it's quite a good lead indicator. As you can see here, and again, don't worry whether it's 2, 3, 4%. Basically, what we know is that prices, certainly asking prices, were going up as soon as lockdown was taken off, just for the home moving market, bearing in mind, and the construction market. The rest of the country at this point hadn't opened up. The Halifax and Nationwide were reporting similar things, so they're also reporting by region that house prices were moving forward. Again, don't worry too much about the percentages, but basically we know that the properties that are coming onto the market are definitely selling for, firstly, more than they were in March, and secondly, more than they were this time last year. So for anybody that's sitting on a property now, that's good news. These are from Maxine. So not only did the property home moving market go completely nuts, the lettings market also just went crackers. So phones were ringing at 7:15 on the Wednesday. Property inquiries were absolutely phenomenally up, of course. Lots of tire kickers though, and that's kind of what we needed to, took a little time to filter out. But lettings increased, despite the fact there's a lot less properties available. That's the same in the home moving market. And the good news, and this is the bit that actually really surprised me, and this may well be because of your local area, typically rents only rise when wages rise. And I can't really believe that over this time wages could have risen, but likely due to the shortage of stock, if a tenancy agreement was coming to an end, then rents were looking at about 4% higher. So that's a little bit of a surprise, because most people are kind of predicting they won't, they'll sort of flatten or go backwards a bit this week. And no need to negotiate on rentals. So to be honest, nobody could have expected or wished for, if you like, a better market to come back to. However, what happens next, and a lot of the confidence in our home moving market comes from what friends and family tell people to do, but also from the media. I spend a lot of my time trying to encourage agents, and Maxine's been great at bringing this on board, that it's Maxine's responsibility to tell you and to explain to you why you should trust her rather than the media. And I'm reinforcing that you absolutely should. There's been some quite shocking media reports while we're seeing this boom in the market, and I'm going to talk through some of those now. But remember, the media has an agenda as much as the government and as much as any company around the country. And their agenda is to get you watching their reports or reading their reports, so that, especially the ones that can sell advertising. So I'm going to walk you through a little bit of what I've noticed from what the media are saying, and then looked into more detail and look at trusted sources that I've had, and they're saying something quite different. The first one is, and I have to say, if and please don't be offended if you are a Guardian reader, but they don't like property much, and therefore they will tend to report in quite a derogatory way on the property market. So this is the title for one that came up at the start of July. UK house prices fell for 4 months in a row. You might think, well, that's outrageous. Kate's just told us that house prices are going up and all of this kind of thing. How does that work? Well, here are the these huge house price falls for 4 months in a row. They were minus 0.3% in March, minus 0.6% in April. Oh, now hang on a minute. The market was closed then. So I'm not going to believe that at all. Minus 0.2 and 0.1. So from my perspective, two things. Firstly, I totally ignore month-on-month data unless I can see a 6-month trend. and unless those figures are going over 1%. Statistically, I do not see through April and May how there could have been good enough data to actually rely on these reports. And the other thing what you've got to bear in mind is this is their headline. UK house prices fell for 4 months in a row. What does that miss? Well, if you run to the end of that chart, despite the fact that prices were coming down a little bit month on month, they were still in March 3% higher than they were last year. And in June, they're still 2.5% higher. But it has been decided that that good news is not going to be reported in headlines, which often people scan. And the problem with that is that the agents on the ground that I was speaking to, they had people ringing up and going, well, I want to offer 20 grand below the asking price. And they're going, well, I'm really sorry, but we've kind of got 4 people interested. And the agents are saying, well, and people are saying, don't you know there's a recession? Don't you know that house prices are going to fall? And then they'd be going, yeah, well, actually, out of the 4 people that have expressed an interest, we've just accepted an offer, and it's actually higher than the asking price. And this is the problem. If we don't tell people exactly what is going on in the market, that causes a huge mistrust on the ground. And I think that's unfair, but it's really important to understand what's behind these headlines. So if you read a headline, that headline can be in property completely different to actually what's in the text. So to be fair to the journalists, they may have written a really, really good story, but somebody's chosen quite a miserable headline, and the two don't even correlate sometimes. So be very wary. Now, I do a lot of work with the BBC, and I work really hard with them, and the ones that I work with have been great. But this is another one which I was staggered at. UK house prices in first annual fall for 8 years. That fall that they were reporting was 0.1% year on year. And I hardly think it is worth that headline. And again, it tells people the wrong message, because that is absolutely not what is happening on the ground. And it's relying on data that, in my view, much as Halifax and Nationwide typically do a good job, actually, I just am not believing it, because it doesn't match anything that I'm hearing on the ground. And the other thing that's really, I can just be honest with you, is winding me up at the moment, is the job headlines. So recently, and this was really interesting, they started reporting and saying, you'll have seen these, UK payrolls shrink by 650,000 jobs in lockdown, etc. And of course, those stats aren't incorrect, but what they're actually telling, what they weren't telling you was this wasn't as bad as they expected it to be. And this, I think it was this week or late last week, what was very interesting was everybody reported job losses in M&S, 950 job losses. Very few places, and unless you knew where to look for it, were turning around, and they may not be the same types of jobs, to say that Hermes was actually creating 10,000 jobs. We've had 20,000 jobs, I think, just for the track and trace system. So, albeit that, yes, there are job losses, there are also job creation, even during these kind of tough times as well. So it's not wise just to rely on these figures, and you have to find better resources, and that's my job, and we'll share some of those with you today. So what are the current forecasts? And as I've said, if you can't kind of listen to the day-to-day stuff, who is worth listening to? Because I think that's useful. So one of the places that you can go to, and at the end of the day, you've got to rely on somebody. And the Office of Budget Responsibility is independent of the government, but it is there as a guide to tell them how it thinks things are going. Other things you can look at are Bank of England, for example. So I'm going to walk you through these economic forecasts. And bearing in mind, they are forecasts, so they could be outrageously out. But the thing I love about this is they must have covered pretty much every base that they possibly could. So just to explain this chart, so when we're talking about the economy and how well it's doing, we tend to cover and measure it by GDP, gross domestic product. And it's a bit like our turnover, if you like, as Britain. So what you can see here is going into as we went into 2020, you can see that yellow line. And what that yellow line is the expected forecast basically before COVID hit. Okay. And then you've got that, you can see that first quarter results came in, and we had this massive fall of over 20%. And the thing that does make me laugh at the moment is the media's going, there's been a historic rise or the biggest fall ever. And it's like, well, yeah, we shut the economy down. We've never done that before. So to be honest, I'm ignoring anything that says big rises or big falls, because of course there are. That shouldn't be a surprise, for crying out loud. But it's just this exaggeration. You can almost see them getting like little sort of bright-eyed about reporting this stuff. But basically what this is saying is, and I'll run you through the two scenarios. So the best scenario, which is the line that joins the yellow one, is that we will start climbing out of this recession that we've had because of lockdown this year, and that by sort of halfway into 2021, we'll be able to, we'll be back on track, if you like. The worst case scenario is that we won't even be back on track in 5 years' time. And I think when we were reporting in May, this kind of V-shaped recession, the kind of what they're calling an upside scenario now, was what they would have expected to happen. And that looks like it's going to be pushed that little bit further back. So where we saw a V-shape of around a year to recover, we could be looking at anything from 2 years to 5 years. And that does make a little difference, and maybe has an impact in terms of what you're looking to do as an investor or as a landlord, for example. I've put you the numbers here, partly so you can kind of go away and have a little look at them and absorb them yourselves, because you're very welcome to this presentation. So what you've got here are the three scenarios. So if we take the upside, the middle scenario first, this is the best picture, that overall we will recover quite quickly. And if you look at 2020, albeit we had that big fall in lockdown of over 20% in our economy, they're expecting that we'll recover enough to only have a 10% fall by the end of the year. The most important thing, two things to look at on here, is what they expect to happen to inflation. And inflation doesn't really change. So the good news is inflation is expected to reduce. That's good news, because if you can't for any reason increase your rents, it means that you're still getting the same wage, if you like, from your rental income. And also that goods and services aren't going to go up that much in cost. So that's good news, expected to stay the same in all scenarios. The bit that everybody's really nervous about, and where the fear is that we'll go into a 5-year recession, is on the unemployment line. So again, looking at the scenario, you can see that 2019, we're just over 1 million people, and that's kind of 3-4%. What they're expected to see is that double. If you look at the kind of worst case scenario, they're expected to see that go up more, and especially go up more in 2021. And that is what's spooking everybody out at the moment, including the lenders. So if you're wondering why the lenders are being a bit tight on their loan to values, that's the figure that's spooking them out. They are very nervous about what's going to happen after October and furlough. And obviously we won't know till then. We can only keep our fingers crossed. So this is these scenarios on unemployment in a little bit more detail. Expected to get worst case, or best case even, expected to get quite scary more in 2021 really. So the initial figures said it would go pear-shaped this year, but to be fair to the government, the furlough scheme looks like it's pushed back to next year. And the reason that's good news is because there are talks at this moment of time, whether it would happen or not, on a vaccine or something medically good news that will help reduce the spread or reduce the severity of COVID by Christmas. And if we got that, that would be the biggest Christmas present ever. And actually everybody would probably be singing the praises of the government, because they've pushed back what would have been a potentially awful recession almost into 2021. So that's where the Office of Budget Responsibility, how I'm walking you through now my two guys that I tend to look at, Capital Economics and the CEBR. And two interesting things from here. These guys have been pretty good at their forecasts, but we are into different times now. We've never seen a recession like this, and we just don't know how good everybody's going to be, and it'll be a credit to both these guys if they get it right. So what they're looking at is, again, 2021 is probably going to be the harder year, and the economy is not going to recover till first half of 2022. And that matches that middle scenario that we've just seen from the Office of Budget Responsibility. And they're not expecting, these guys are expecting by the end of 2022 that unemployment will be higher, but not some of the really scary statistics that we've seen in the Office of Budget Responsibility. And again, they agree with them on the inflation side. When I can see 2 or 3 of the guys that I watch economically agree with each other, that gives me a bit of a confidence that they should be forecasting kind of correctly. I've chosen, rather than choose the kind of economic stuff, because that does seem to fit quite well as to what might happen, that central OBR scenario and the capital economics one. One of the things that everybody's talking about is, well, how on earth are we going to pay for this? And what people kind of believe is that if you kind of follow, this is CEBRs, is they believe that if you follow these steps, and this might VAT, for example, if things go pear-shaped in October, or in the budget, I think it's in September, we may get a temporary VAT cut, which worked very well in the last recession. This is the views that CEBR have of how we can survive. And the big one to look at is, don't worry about paying these back for the next 50 years. Never happened before, but remember, this isn't just us in this scenario, it's the whole world. So if it was just us who are in so much debt, it would be a problem. But because the whole world is going to be in debt, what they're looking at is that it's actually okay to pay these things back over a period of time. And they're looking at the timings of how money was paid back after the Second World War, etc., because those are the only things that we've got to base this on. So there is a real belief there that we can get through this, and it won't sort of hit us for huge amounts of time if we get the economics of this right. So you might sort of say, well, that's all very lovely, Kate, but what on earth do I care? I'm in property. And the reason you've got to care about it is, if you don't understand what's happening in the economy, then you won't understand the headwinds that are coming up in property or the opportunities. So what happens in the economy, and certainly what the media says, influences people's confidence. That influences whether they'll buy and sell or prefer to rent. And the rental market, I have to say, does very well during recession. So might lose a bit of rent, but actually more people tend to rent than they are willing to buy and sell. But you have to understand that wages set rents. You don't set them. It depends on what people can afford in their back pocket. So we're not expecting wages to rise much this year. So whether that 4% that Maxine's seeing at this moment will continue, I'd be surprised if it is. So I'm just pointing out that that might be a bit of a headwind. The unemployment affects who your tenants are. So your tenant today, if they're on furlough, by October, you might actually find that they're going to turn into a tenant on benefits. Actually, nothing wrong with that whatsoever. Be aware of the discrimination case, which I'm sure Maxine can talk more about. So because private rental tenants and universal credit tenants are almost an equal risk now, universal credit tenants aren't a risk because of the person. They're a risk because there's so many problems with the universal credit system. But because that private rent person might then lose their job in October, it makes them more of a equal rent. So if you haven't looked at universal credit tenants before, actually now really is the time to do that. Interest rates, of course, influence mortgage costs. We have the lowest interest rates we've ever seen. There is some talk that they'd move into negative territory, but that seems to have disappeared at the moment. And I think we are seeing mortgage costs probably at their lowest than we've ever seen them before, because we're actually seeing mortgage lenders increase some of their mortgage rates that they have. And on lenders, they are nervous at this moment in time, as I said before, because of unemployment, and they do also have a workload issue. So the mortgage payment holidays, for example, has caused them a real headache. And you may well find, therefore, so for me, if you're looking at mortgaging or remortgaging, definitely go to a broker who can manage all of this for you, as opposed necessarily to somebody direct. So the economy very much feeds into property supply, demand and pricing, be it rents or prices. So it's really important to kind of keep up with what's going on. So based on these economic forecasts that I've chatted through, how is the property market expected to perform? So one of the forecasters I follow, and we follow about 5 or 6, is Savills. They've produced these, which show you what's going to happen by each region, and then show you what's happened through by each year. They're pretty accurate. I'm not sure that they've got this year's right, if I'm honest. So what they're suggesting, and this is new from what we saw last time, is that every single area on average is going to fall by about 7.5%. Personally, I don't think that's going to happen. I think that Areas like the southeast, the southwest may fall by that amount, but London I don't think is going to fall too much. You're pretty strong in the east of England, so you've already had some falls there, so I'm not sure you'll fall by that much. If you take somewhere like the northeast, well, their house prices are still on average 9% lower than they were 13 years ago, so it'd be quite shocking if their prices fell again. What they're then suggesting is that you'll basically within a year or two that will be recovery. So they're looking at a different recovery, because they're saying London, for example, in the southeast is in a much stronger position than, for example, in Wales. So Wales next year, 2% increase, southeast is looking at an 8% increase. And the interesting thing with all of this is if you take where it's the end column where it's got the orange there, and you compare that to the yellow column, Savills look at all of these forecasts and then say where we're going to be in 5 years. And if you're investing, you should really be looking at those levels. And what the real message is, look, we've got a bit of a bump in the road. We don't think it's going to be as bad as normal recessions where you'd see a 20% fall, and that's what we saw in the last credit crunch. And in actual fact, what they're saying is it'll be a little bit bumpy over the next 5 years. There'll be different recoveries, but do you know what? They think property prices will increase as much as they did, as much as they forecast before COVID. So they're not expecting essentially a long-term effect. Overall, taking Savills out of it and looking more widely, we're seeing that the property industry and people like Capital Economics that seem to have got their heads around housing much better than they had pre-2007, about a 5% fall to 10%. More on the economic side, Bank of England, CEBR indeed, they're suggesting 13 to 16% falls. And I think the reason they're doing that is because that's what you'd see in a recession. And I think I'm going to rely a little bit more on the property guys, but I'm going to talk about that in a little bit. My forecasts, and you've got the rental ones here. The rental ones are very straightforward. And if you look at the bottom chart table that we've got there, you can see income is expected to fall by 1.6%. Rate rise next year and keep rising. And again, that 5-year rate from Savills is exactly the same as the 5-year rate that they put out before COVID. When you start then looking up London, UK, and the UK excluding London, what you can see they're doing is they're matching those increases in rents to the increases or falls in income. So you can do this really locally. So if in Cambridge you're seeing, you might see in Cambridge, because it's quite a strong economy and quite a long-term economy. So a lot of the science areas, they work on kind of 50-year models. You may not see any falls in wages at all, in which case your rents will hold up better. So it's all about your tenant, how they're earning their money at this moment and who they work for. Occupation is going to be very important over the next 12 months. So rents will very much react to wages. I think we're going to see a massive difference in pricing changes than we have in any other recession before. So standard wise, in the credit crunch recession in the 1990s, we saw prices fall by around 20% in both recessions and pretty much right across every single region on average. However, since the credit crunch, the one thing I noticed by working with people like Maxine on the ground is that prices are basically going up, down and staying the same. And that could actually be for properties on the same street. It's all about localized supply and demand. So I'm expecting really popular properties that would go to doctors, consultants, people in retail, because they come up to market so rarely. I don't think they're going to fall in price at all. And those are probably ones that we're seeing some quite good increases at this moment in time. Whereas other areas, if you take a coastal town that's really reliant on hospitality, really reliant on catering, entertainment, they're going to really struggle over the next 6 months, year. So they could possibly, if you've got a lot of supply and not much demand, they could possibly see the recession falls of 20. So I'm giving myself a very wide range of saying that actually that properties might fall by nothing to 20%, but I do think that will work out on the ground, and that's where you'll probably see on average the sort of 5 to 10% falls that will get reported in the media. But it doesn't matter. All those averages don't matter. What matters is what price Maxine thinks a property is worth on a street and what rental price she thinks it's worth. Because I don't care who's doing the reporting, she will know better than anybody else, because it's all about that property on the street. So we've gone through quite a lot of information today. How on earth do you kind of keep up with it? And bearing in mind, this is kind of my bread and butter on a daily basis. What I've done for you is put down all the places that I go to. So you're very welcome, obviously, to come back and talk to either of us at any time. But I thought this might be useful if it's something that you want to take on board yourself. What I did notice, and I noticed this on the job losses actually when they were reported, Radio 4, the AM and the PM programs, news programs, tend to be much more balanced. So I watch BBC Breakfast, or I'll have a listen to Radio 4, and they will tend to report all the job losses, whereas BBC, Radio 4 will do a little bit of both. You've seen, I've walked you through the economics data that I look at. And property market wise, we do a monthly report on prices under property checklist. It's all free of charge. So if you sign up to that, or just come back and see us when you're ready. We have to produce it by about the 12th, 13th of the month. So that'll be available. And we summarize all the price reports we can get our hands on. Savills have got some good stuff, and Home Track is another one. It's part of the Zoopla group. Those two are really, really good and good forecasters. And also Knight Frank have been doing some nice stuff. Rightmove, although that index is kind of useful at the moment, the real interesting thing is the sold property price data. If you want to know what's happening in your area, go and find properties that are for sale at this moment in time, and then look at the back history for 20 years of the price inflation for that particular property on that particular road. That's all that matters. And if you don't fancy doing that, get Maxine to do it for you.
Thank you.
So what else do you need to know? I'll just run through this quickly. Always like to pop a little surprise in there. So current changes, we've got the stamp duty change. So homeowner rates, so just one property, previously paid stamp duty up to £500,000, that's now gone. If you are buying up to £500,000 as an investor, second homes, you still in England have to pay the stamp duty rate. Scotland and Wales have also got their own rules and regulations. So don't think this applies nationally. It doesn't. Hugely important. And again, I know Maxine will be on top of this. There are new rules on possession. You must get to grips with those. I have to say, if you are working with good agents like Maxine, the chance of this happening will be very, very, very low. But you need to be prepared just in case. We've also got new leasehold rules potentially coming out. So if you own a flat, if you're a bit frustrated with the leasehold system, there is some good news. And I know people are a little worried about the talking capital gains tax. I think it could well increase. There was before, a few years ago, a proposal to move these in line with income tax, so 20, 40, 50%. And there's a danger that might happen. So if you have not got a tax specialist working on your behalf, go and get one, because they can help you before tax changes. But if tax changes come in September, say, for example, they're not going to be able to help you. So I hope that's kind of useful. And really, if you can either go and do that stuff yourself, or indeed you can just come and talk to me and Maxine, and we'll keep you up to date with everything. Hope that was useful.
No, that's absolutely brilliant, Kate. And thank you so much for the extra work. I so appreciate it. but I suppose you brought up about the 4%. You know, how come we were bucking a trend? And I don't think we're bucking a trend. Over the last 7 years, we've really been working with our landlords on future-proofing their assets. So rather than just keeping everything the same, you know, you could decoration in the 1980s, the colour schemes and things like that, we're really saying you must change these things, just gradually, not every time, or maybe now because of the tenant fee ban, you do it whilst the tenant's in place. And a lot of what we're putting on, and the reason why we're able to get extra, is the properties we're marketing, I think, but maybe I would say that, wouldn't I? They are better quality. So people will pay for the quality, but also they'll see that the landlord, they've put new carpets in, they've redecorated, we've got plans to put a bathroom in. And that's where, you know, it's not 4% is not coming from out of nowhere. I think it really is a case, the product is better, and those that want to pay extra, can pay extra, will pay extra.
Yeah, I mean, that's absolutely true. I mean, we always say, if you've got your property in a good condition, Certainly on the rental market, with all the things you hear about bad landlords, if you've got a decent agent, decent landlord, people will pay for it, and they can. Certainly the ones that have, you know, have been quite successful during this period of time. And of course, with properties being quite short supply, still, then you're able to get that little bit extra out of them. And fair play, you know, to you, that's the difference between an ordinary agent and a great agent.
Oh, with a great agent.
Can I ask a question, Kate? I mean, it's a really silly little question, really. But when you showed the slide about CBR, you mentioned that zombie firms, and I didn't know what a zombie firm was, and I just wondered what that meant.
I think it's so. God, do you know what? I copied and pasted.
We're all going to be zombies.
So zombie firms are ones that are kind of operating now, but they probably shouldn't have been operating up until COVID. So kind of existing, but it's about everything that's going on at the moment is about spreading the pain for as long as possible, and there has to be acceptance. It's quite interesting when you see it with the theatres and everything today. The government is just expected to bail everybody out.
Yeah.
And that's fine, but we're going to have to bail everybody out that's bailing everybody out. And I'm really sorry, sometimes stuff will have to go, and it's really hard on people. But that is just the way things are. And this has been incredibly cruel. But, you know, you've got to understand that they are just trying to spread that. And I do think that's the right strategy. They have no choice. They can't pay for everything.
I think that as well, you know, it's just sped up a lot of things that weren't going to happen anyway. So, you know, just, businesses have changed. I mean, we've seen it in our industry massively, how businesses are now maybe thinking about, do they need to have the high street offices? Do they need to have these, you know, sort of big places where everybody comes and works, when actually we manage perfectly fine with a lot of people working from home. So I think that, you know, so many changes are going to happen in business. But like you said, when you were talking about the unemployment figures, there will be some businesses that have gone, but there's so many other businesses that are suddenly getting bigger and bigger and are coming to the forefront that perhaps weren't there before. I mean, who made face masks before? And now there's people, like, you know, earning a fortune making face masks. But, you know, it's like, it's just a change, and that obviously changing scenario. The other thing I wanted to ask, on the stamp duty, I know at the moment it's all going to end in one fell swoop, but do you think that they'll change that at one point? Do you think they'll phase it out slower? Because otherwise we're going to have like this massive sort of, you know, off a cliff
drop off in March.
Yeah, I mean, the danger is, to some extent, by doing what they're doing, is from everything from the people I'm talking to at the moment, is what they're doing is bringing forward to between now and October an awful lot of demand. And indeed, and that includes supply as well, and that's not a bad thing. So the danger is that they might extend the property market out till the end of October, but I actually think there's a potential to kind of, from a buying and selling perspective, good news on renting, of course, to fall off a cliff November, December, and particularly if we have a second wave. And I'm hoping that won't happen because of the localized work that they're doing at the moment, which is again a good strategy. So I'm not so sure that March deadline will be as big a cliff as it has been in the past, partly because there is quite a long notice. Interestingly, if you do want to sell, the average time to sell a property is 20 weeks, which is 5 months. So if you're hoping to save that money, you've got to have your property on the market before the end of September. And make your offers before Christmas. So then you start looking at it like that. Anybody coming back in January, February, March, they're going to have to race to get that, and they're going to find that quite difficult.
Would you buy now, invest now? I mean, I know you've got to still pay your 3%, but obviously saving the...
so I definitely sell now. So if you want to sell properties, now is the time to do it. And I kind of want to get a property on the market, certainly at the latest this year, by the beginning of September. Wouldn't want to put it on much longer than that. From a buying perspective, and certainly from an investor perspective, it depends what you're looking for. If you're looking for a really long-term investment, now might be a good time, but don't forget, prices are expected to go up to 3% this year. Lots of investors are posting, well, I've got extra money and extra cash, and I actually can't, none of my offers are being accepted because they thought they were going to get deals. So the deals I can't see being around until sort of November, December, and maybe early next year. And if a vaccine comes along, well, of course, that might change everything as well. But even if that does happen, we are still bringing a lot of demand and supply forward.
Yeah. And also, Kate, I'm one of the people that are telling landlords to offer low on investments.
Well, that ain't going to work.
Why?
Well, I don't know. I'll take on the basis it's working in a couple of times.
Yeah, and it always will. So even in the booming market, as long as it's all about the need, isn't it? So if you've got cash buyers,
absolutely, yeah, and that's the thing
they're
with an investor.
Yeah,
I mean, that's the thing with an investor. They are usually lined up, ready to go, as opposed to someone in a chain. So there actually is a benefit there. And I think that's where the negotiation is. But I'm always going, look, use the 3% as your basic negotiating figure, because you're going to have to pay that. So just use it.
Yeah, definitely. But what I can't stress enough is to get that tax help. There are so many landlords out there that do not have that tax help. For crying out loud, I have warned you, and I can't save people after the announcements have been made. So you've got, I think, is it September, Rishi Sunak's expected to do another budget or something. So get that sorted.
We got lovely Tony, don't we? Can put people
That's it, Tony. She hopefully is there.
Yeah.
Hopefully she's watching. Are you there, Tony? She's normally there.
So she can come back. Yeah, no. Well, Kate, that was really great. But actually, I just remembered the whole reason this conversation came about was there were some stats that I saw in the local news, which was effectively saying, and I know you've looked at other things since, and I couldn't find my original figures, but it was saying something like in the Cambridgeshire area, people were paying 41% of their annual income. But in Oxford, they were paying something like, and as I said, I had it in my head, at 78% of their annual income. And it was like, what was the difference there?
Okay, so first thing is ignore those figures.
Should have just run you up.
So for the simple reason is when you're looking at average rents and average wages, particularly of areas like Oxford and Cambridge, you're looking at extraordinarily successful people and extraordinary high-priced homes versus quite low-priced homes and and people that are on minimum wage. So for me, averages won't work. You're also looking at two university towns. So you have the complication then of what happens when everybody comes flooding into universities. HMOs, for example, the percentage of HMOs, etc. Now, in theory, you'd say, well, surely Oxford and Cambridge should be fairly similar. The difference will be, I think, the geography. Because if that Cambridgeshire has anything to do with the likes of around Cambridgeshire, there are some cheaper places. Oxford has got what we call a noose around its neck, because there is nowhere within that kind of A34, M40 belt. There is nowhere until you go quite some distance outside of that where you find reasonable places such as Bicester, which will have a lower average. So I imagine, my gut says it would be something between those, but I am not a fan of these averages at all. And I wish they weren't used, because they tend to get misused against landlords and against the investment community. And you get accused of skyrocketing and extortionate rents, and it's completely unfair.
That's it. Well, I
Don't
didn't
worry about it.
How anybody could use 78% of their income to pay the
Well,
rent.
exactly.
Like, oh my God, what do you live on?
Yeah, precisely. I kind of look at that and I'm like, nah.
All right. Thank you very much, Kate, for putting me in my place yet again. But that was like, I don't know whether you can see any questions, Jane, or anything like that at all.
We haven't got any questions. We've just got Tony watching, who says ignoring journalists and data is something she can do, Kate. So if anybody wants a tax advice, Kate, Tony's on there. So just
please, Tony.
Yeah, no, that's
you don't get paid for that bit, but it's best. It is the best thing you will ever do. I promise you. You'll thank myself, Maxine, and you for years to come.
Absolutely. I've learned so much, Kate, as always. Like literally, I've written like tons and tons of notes. I know I've got your slides, but I was just scribbling away, like writing my notes. And it is an uncertain time, but I'm actually quite excited by it. I find it quite thrilling when we go through times of change, because I think that, you know, lots of new interesting and you know, great stuff comes out of it. So it's good to hear positivity. I think as well, a lot of people during lockdown actually had a lot of money that perhaps they would have been spending in restaurants and bars and clubs and shops and everything else. And, you know, that's kind of going to continue, I still think, a little bit, because I don't think, although a lot of people are going back out, I think there's still an awful lot that aren't, and perhaps we are going to, you know, get a bit more sensible, those that are running around. So yeah, I think that would be good for the economy. There's more money coming in because more people have got disposable income sitting in their banks to spend. So
11% extra according to Halifax.
Brilliant. I know it is, yeah. So we shall see.
Yeah.
So
All right, then.
thank you so much for everything, and lovely to see you guys again, and we'll see you soon.
Okay, so this will be recorded, won't it, Jane? So we can put this out later for people to see.
We will do, yeah, absolutely.
Lovely. Well, thank you for your help again, Kate. Thank you so
Absolute pleasure.
much, and see you next week for the update.
Take care, everybody.
Bye.
Cheers.